Ever pondered over the mechanism of currency exchange rates? It's not as complex as it may seem. Let's kick things off with understanding currency. In its simplest form, currency is the money in circulation within a country. It's the lifeblood of our economy, facilitating trade both domestically and internationally. From buying a cup of coffee to purchasing an airplane, currency is what makes it possible. Now let's introduce a new player to the game: exchange rates. They are the value of one country's currency in relation to another's. Think of it as the price you'd pay to buy a different country's currency. These rates play a vital role in the global economy, affecting everything from the price of your imported goods to the cost of your next overseas vacation. So, buckle up as we embark on a journey to decipher the world of currency exchange rates. Currency, in simple terms, is the money in circulation within a country. It's the tangible representation of value that we use every day to buy our morning coffee, pay for our groceries, or save up for that vacation we've been dreaming about. It's the lifeblood of our economic system, fueling transactions and facilitating trade. But what makes currency so special? Well, it's not the paper or the coins themselves. Instead, it's the functions they serve. First and foremost, currency is a medium of exchange. This means it's something we all agree has value and can be traded for goods and services. Imagine trying to barter your way through life, trading chickens for shoes or hours of work for a bag of flour. It would be chaotic, wouldn't it? Currency simplifies this process, providing a common language of value that we can all understand. Next, currency serves as a unit of account. It gives us a standard measure to compare the value of different goods and services. Without it, how would we know if a loaf of bread is worth more or less than a gallon of milk? Currency gives us a way to compare apples to apples, or in this case, dollars to dollars. Finally, currency acts as a store of value. It allows us to save and plan for the future. If you've ever tucked away money for a rainy day, or put cash in a piggy bank for a special purchase, you've used currency as a store of value. Around the world, different countries use different currencies. There's the US dollar, the backbone of international trade, the euro used by many countries across Europe, or the Japanese yen, a major player in the Asian market. Each has its own value, its own symbol, and its own story. Now that we have a basic understanding of currency, let's proceed to the next big question. What are exchange rates? Exchange rates, simply put, are the value of one country's currency in terms of another's. Now, if you're thinking of this in terms of swapping your dollars for euros or yen for your next international trip, you're on the right track. However, exchange rates are more than just a tool for travelers. They are a fundamental aspect of international trade and economics. When you hear the term exchange rate, you should think of it as the price tag of a country's currency. Like any other price in a market, it fluctuates based on supply and demand. If a country's currency is in high demand, its value or exchange rate will rise. Conversely, if there's less demand for a currency, its value will fall. This ebb and flow of currency value is a constant dance influenced by a myriad of factors from economic stability to geopolitical events. You might wonder why this matters. Well, these fluctuations impact the cost of imports and exports. For instance, if the value of the US dollar increases compared to the euro, American goods become more expensive for Europeans. This could lead to a decrease in exports from the US to Europe. On the flip side, European goods become cheaper for Americans, potentially increasing imports from Europe to the US. This is why businesses keep a keen eye on exchange rates. They can significantly impact profitability, especially for companies that do business internationally. Moreover, exchange rates affect you personally too. Say you're an American planning to study in the UK. If the dollar weakens against the pound, your tuition and living expenses in the UK will effectively become more expensive. So you see, exchange rates are not just numbers on a screen. They are a dynamic aspect of our global economy, influencing everything from the price of your morning coffee to the cost of your dream vacation. In conclusion, exchange rates play a vital role in a country's level of trade, which is critical to most free market economies worldwide. Now, isn't that worth more than just a penny for your thoughts? Ever wondered why exchange rates keep fluctuating? Let's dive into it. To understand why the value of your hard-earned dollars can bob up and down like a buoy in the ocean, we need to look at some of the key factors influencing exchange rates. These factors are as varied as the colors of the rainbow, but we'll focus on three main influencers: inflation, interest rates, and political stability. First, let's talk inflation. Picture this. If you had a magic suitcase that could produce $100 every day, but the price of everything doubled overnight, your magic suitcase wouldn't feel so magical anymore, would it? That's inflation at work. When a country experiences low inflation, the purchasing power of its currency tends to rise. A good example is Japan, which has battled with low inflation for years, leading to a strong yen. On the flip side, high inflation can weaken a currency. Think Zimbabwe in the late 2000s, where hyperinflation led to billion-dollar banknotes that couldn't even buy a loaf of bread. Next up, interest rates. Imagine you're a big-shot investor. Where would you put your money? In a bank offering 1% interest, or one offering 5%? The answer's pretty obvious. Higher interest rates attract foreign capital and cause a currency to appreciate. For instance, in the early 80s, the United States ramped up interest rates to combat inflation. This attracted a flood of foreign investment, causing the dollar to appreciate. Finally, let's talk political stability. If you had to choose between investing in a war-torn country or a peaceful, stable one, where would you put your money? Most likely, you'd choose the latter. Political stability and economic performance are attractive to foreign investors. A stable political climate allows a country to effectively manage its economy and attract foreign investment, strengthening its currency. Consider Switzerland, often seen as a safe haven during times of international tumult. Its political and economic stability has contributed to the strength of the Swiss franc. But remember, these factors don't operate in isolation. They're like a team of synchronized swimmers, working together to influence the value of a currency. Central banks often juggle these factors, using tools like monetary policy to keep their currency's value in check. Of course, there are other factors at play too. Things like current account deficits, public debt, terms of trade, and economic growth can also play a part. It's a complex, ever-changing landscape, making the world of foreign exchange as dynamic as it is fascinating. So the next time you're on vacation, and you notice that your dollars aren't stretching quite as far as they did last year, remember, it's not just about numbers on a screen, it's a reflection of a country's economic health, its policies, and its place in the global economy. As we can see, a multitude of factors work in tandem to determine the exchange rate of a currency. Exchange rates are not just numbers, they have a profound impact on the economy. Let's dive right in. Imagine you're a manufacturer exporting goods to another country. If your home currency strengthens against your buyer's currency, your goods become more expensive for them. This might lead to a decline in your sales. Conversely, if your home currency weakens, your goods become cheaper, potentially boosting your sales. This is the magic of exchange rates. They directly affect the trade balance, the difference between what a country exports and what it imports. Let's take this a step further. A country's trade balance influences its current account, which is a broader measure of trade that also includes income from abroad and unilateral transfers. So, a stronger currency might lead to a current account deficit, while a weaker currency might lead to a surplus. Now let's talk about inflation. Inflation is the rate at which the general level of prices for goods and services is rising. Exchange rates can have a significant impact on this. For instance, if the value of a country's currency falls, imports become more expensive, which can drive up inflation. On the flip side, if the currency strengthens, imports become cheaper, which might reduce inflation. Let's put this into perspective with an example. Imagine a country, let's call it Econoland. If the value of Econoland's currency falls, it becomes more expensive for Econoland to import goods. This could lead to higher prices for imported goods, driving up inflation. However, it also makes Econoland's exports cheaper for foreign buyers, possibly boosting exports and stimulating economic growth. This brings us to our next point: economic growth. Economic growth is the increase in the goods and services produced by an economy over time. Exchange rates can impact this too. A weaker currency can stimulate economic growth by making a country's exports more competitive. On the other hand, a stronger currency can slow economic growth by making a country's exports more expensive. Let's go back to our example. If Econoland's currency weakens, its exports become cheaper for foreign buyers, potentially boosting sales and stimulating economic growth. However, if Econoland's currency strengthens, its exports become more expensive, which could slow economic growth. So, as you can see, exchange rates play a vital role in the economy. They can affect everything from the price of your morning coffee to the overall health of a country's economy. Exchange rates are not just about the cost of your next holiday abroad. They have far-reaching implications for trade, inflation, and economic growth. So, the next time you see the exchange rate fluctuating, remember, it's much more than just a number. So folks, that was a quick dive into the world of currency and exchange rates. We've journeyed from the basic concept of currency that trusty medium of exchange that makes our daily transactions possible, to the intricate web of exchange rates that connect these currencies together on a global scale. We've seen how currency, in its various shapes and forms, is more than just paper and coins. It's a tangible representation of a country's economic health and standing in the international marketplace. Its value can be influenced by many factors, from inflation rates to political stability and even public debt. We then moved on to exchange rates, those ever-changing numbers that dictate how much of one currency you can get for another. We've demystified these rates, showing how they're not just random figures but are determined by complex factors such as interest rates, economic performance, and geopolitical events. We also delved into how these rates can impact an economy, affecting everything from the price of imports and exports to the attractiveness of a country for foreign investors. A high exchange rate might make your vacations cheaper, but it could also make your country's exports more expensive, impacting businesses and potentially job opportunities. Understanding these concepts is not just academic. For finance students and professionals, it's crucial. It helps make sense of the global economy, informs investment decisions, and even guides business strategies. But even for the average Joe, having a grasp of these concepts can help navigate the financial news, make informed decisions about overseas travel, or even just impress at a dinner party with some witty financial banter. Remember, the world of finance is not an enigma, it's a fascinating puzzle waiting to be solved. So, keep learning, keep exploring,